Okay, in this session, we're basically focusing on a financial accounting concept which is known as control accounts. And the primary focus will be based on the following: trade receivables control account, also known as trade debtors control account, followed by your trade payables control account, also known as your trade creditors control account, summing it up with your trade inventory control account. All of these accounts are interlinked. There is no avoidance in that whole trade. So our essence of this lesson, we will primarily focus our attention to trade receivables control account, and for us to best be suited in driving this point home of getting to grips with trade receivables control account is to use an imaginary company that we likely own. So this imaginary company, let's make it a manufacturing company that manufactures clothing items, and it has a customer base of retail outlets that sell clothing items to third parties. So these retail outlets are basically our trade debtors. So they represent an asset for us. And we also sell to these retail debtors or these trade debtors on a credit terms, meaning that they would only make payment to us once having gotten the actual clothing item in the form of purchases that they would have made from our manufacturing company. They would only be expected to pay at a later date. And that would be how the actual control account phenomenon will come into play, because a control account basically comprises in this regard of our debtors balance versus the payments that would essentially be made by our trade debtors, that being our retail outlets that we usually sell to on a credit terms. So what would bring down our control account, debtor account, would be the form of payments. In other instances, it would be discounts and VAT that's written off as well. But to drive the point home on a simpler basis, we will primarily focus our attention of the debtors control account being brought down strictly by payments having to be made by those trade debtors. Let's now shift our attention to the whiteboard. So on the whiteboard, we've dotted down a few things just to actually save time and to drive a few points home. On this side, I've dotted down a header which reads as trade receivables / debtors. On this side, I've got a trade receivable control account, and when we move over to this side, I've tackled that side over here, payments, and the one next to it is titled trade debtor balances. Right, so let's move back to the first column of the whiteboard. So on the side of the whiteboard, I've got trade receivables, also known as trade debtors. So company sells clothing items on credit. That is the sentence which is captured there. So I've got a customer A, customer B, customer C, customer D, customer E. These are our retail customers who are in the retail industry selling clothing items. So they made purchases from us. So customer A made purchases of socks for 10,000 Rand, followed by B, 20,000 Rand for dresses, 5,000 Rand for C for shoes, 2.5 thousand Rand for hats for D, and 1.5 thousand Rand for shirts for customer E. That's basically where we are. So moving over now into the middle, which we have now termed control account, we've got a reporting period of February 2019. So this is where our primary focus is at this point. We've got a control account. We're going to look over at the payment side. So over on the payment side, okay, which is clearly visible, I see that Customer A made payment of 10,000, B made payment 10, C made payment 2.5, D made payment of 2.5 as well, and E made no payment because there's zero. So we need to remember that trade debts or trade receivables represent a form of an asset for us. So by the time these people that are our clients bought from us and they would pay us at a later date, we would have recognized an asset by putting through a debit entry in the debtors account, also in this instance referred to as the trade debtors account, and we would have recognized an asset of A for the amount of 10,000 rands because that's what he bought for. For B, we would have recognized an asset of 20,000 rands because that's what he bought for. Alright. And for C, we would have recognized an asset of 5,000 rands. That's the value of stock he took. And D, we would have recognized an asset of 2.5 thousand rands because that's what he took in terms of purchases. E, finally, we would have recognized an asset of 1,500 rands because that's what he took. So to remember what would now bring down the debtors account in terms of this account coming down now, it would have to be brought down by payments. That would be represented by a credit entry within the debtors account. Okay, so I'll differentiate this by having to just draw a line straight through to differentiate as to the difference. Okay, so payments would likely bring it down, the balance. So maybe let's just totalize the section to know just how much in aggregate these customers owed us at that February reporting period. So in total, it looks like we owe 10,000 plus 20,000, which is 30, plus 5,000, which is 35,000 rands, plus 2.5, which is 37.5, plus 1.5, which is 39,000 rands in terms of our debtors balance, which is an asset for us. It's standing at 39,000 rands so far as that asset, which is represented in the form of trade debtors account. So we see that there were payments that were made by specific debtors. So for A, we see that A made payment of 10,000 rands and they initially owed 10. We'll come back to that. And so let's just say payments over here. Okay. And for B, they made payment of 10,000 rands from this side, and though they owed 20,000 rands. And for C, they made payment of 2.5 even though they owed 5,000 rands. So we'll dot that down as well. And for D, they made payment of 2.5 as well, though they owed 2.5. So they made full payment at that stage. For E, they did not make any payment whatsoever, so it's 0. So let's just maybe totalize this and get a sense of how much we are owed at how much money was paid over to bring down the value of that debtors balance at that stage. So we paid 10,000 plus 10, 20 plus 2.5, which is 22.5, plus 2.5, which is 25,000 rands. So at that stage, the debtors balance would have been brought down by 25,000 rand against 39,000 rands. So now we need to work out what is the actual balance of the trade debtors account at that stage. So let's go line by line in terms of all the trade debtors so far as payment made against what they initially owed. So A, it looks like you've paid his account in full because he paid 10,000 for 10,000. And as for B, it looks like he owes 10,000 rands because he paid 10,000 against 20,000 rand. And as for C, it looks like he owes 2.5 thousand rands because he paid 2.5 thousand rands against 5,000 rands. And as for D, it looks like he paid up his account because he paid 2.5 against 2.5. And as for E, it looks like he owes 1.5 still that customer because he has not made any payment whatsoever. So let's do that. So if we totalize this, it should now give us the total balance of the debtors account outstanding at that stage. So let's quickly do that. So 10,000 rands plus 2.5, which is 12.5, plus 1.5, which is 14,000 rands. So 14,000 is our debtors balance at that stage. So in order for us to make sure that we're not making any errors, we should now be looking at the balance outstanding, which I'll basically put this outstanding. Okay, I won't finish the actual word, but outstanding, just keep that in. So the balance outstanding added to the 25,000 rand, these two values in total, if combined, they should be giving us the total value of the original debtors balance that we had initially when the trade debtors made their purchases. So now let's quickly do this check. 25,000 rands plus 14,000 rands, that gives us 39,000 rands. So then we are in balance. And now the other part to remember is that the 14,000 rand outstanding now represents a balance which will have to be carried forward, which will be the opening balance for our trade debtors balances for the month of March, because we are in a February reporting period. So now we can move over to the last column of our whiteboard just to actually see as to how far we are. So the last column of the whiteboard, here we are. So let's consult debtor A. We know that he owes us 0 because he paid up in full. And debtor B, we know that he owes 10,000 rands because he used to owe 20 and paid 10. And C, we know that he owes 2.5. And for D, we know that he owes 0 because he paid up his account in full, good customer. And E, we know that he owes us 1.5 because he never paid, as we just figured out on that side. And of course, this is the carry forward balance that we have, which will now be the opening balance of 14,000 rands for the month of March. Okay. Because we've gotten to get to grips with what was paid and what was not paid. So control account, basically very important part of this actual debtors account in this regard, because it gives us a current view of what is outstanding and what is being paid. So that would be a good measure of seeing if we are in balance. So that told us that payments were made and this is the outstanding. Hence we call this a control account, because there's control. We understand what payments were made, we understand what is outstanding, which initially becomes our opening balance of the trade debtors balances for the 1st of March, the following month, because we're dealing with a reporting period of February. I hope that makes sense. And that's basically where we are with the trade debtors control account. If you get that, you're super good.